Welcome to this edition of Ethical Sustainable Investment News and Analysis to Profit By. I'm Ron Robbins, an ethical investing pioneer for over 40 years, quoted in the Wall Street Journal, MarketWatch, the Globe and Mail, and numerous other media, and founder of the highly respected global ethical sustainable investing information website, Investing for the Soul. And please listen to my disclaimer statement at the end of this podcast. Now enjoy this podcast. Hello, Ron Robbins here. Welcome to podcast episode 39, published on August 28th, titled ESG Stocks, ETFs for August, and more. And presented by Investing for the Soul. Investingforthesoul.com is your site for vital global ethical and sustainable investing news, commentary, information, and resources. Remember that you can find a full transcript, links to content, including stock symbols and bonus material, at this episode's podcast page located at investingforthesoul.com/podcast. And Google any terms that are unfamiliar to you. In my last podcast, I covered analysts' views on what stocks would do well under a Biden presidency. Well, a Benzinga.com post, which I saw on MarketWatch.com, had its say in a post titled 3 Alternative Energy ETFs for a Biden White House. Here are its recommendations with relevant quotes following them. Quote, "Indeed, Biden has an ambitious plan for renewable energy in the U.S. With that in mind, here are some renewable energy ETFs to consider in advance of Election Day and if Biden wins beyond. 1. Alps Clean Energy ETF. Things could come up aces for the Alps Clean Energy ETF if Biden wins the White House. The fund is up 52.55% this year and has more than doubled since its 2018 debut. The Alps Clean Energy ETF doesn't just focus on wind and solar. Other exposures include smart grid, electric vehicle and energy storage, biomass, biofuel, fuel cell makers, and geothermal producers. 2. Invesco Solar ETF, the second largest renewable energy ETF by assets. The Invesco Solar ETF is higher by more than 70% this year. 3. Van Eck Vectors Low Carbon ETF. The Van Eck Vectors Low Carbon Energy ETF tracks the Ardor Global Index, which is intended to track the overall performance of low-carbon energy companies, which are those companies primarily engaged in alternative energy, according to Van Eck." End quotes. An almost regular analyst to this podcast is Will Ashworth, an Investor Place contributor. His most recent article is titled 7 ESG Stocks that will deliver for every stakeholder. In the article, he writes about the recommendations of his interviewee, Randall Dishman, Senior Portfolio Manager at Invesco. Here are the stocks discussed, followed by some quotes from the article. 1. Microsoft. If you've held Microsoft stock since the board appointed Nadella CEO on February 4, 2014, and are still holding, you're sitting on a 450% unrealized profit. And according to financial data company EPFR, $2.34 billion in Microsoft stock was held by ESG funds at the end of 2019, the largest weighting of any U.S.-listed company. Microsoft says it's taking a tough line on its environmental footprint. It says it will be carbon negative by 2030, and that by 2050 it will have removed all the carbon it has emitted since it was founded in 1975, says Quartz contributor John Dextry, reported in February. 2. Salesforce. Salesforce CEO Mark Benioff began to talk about stakeholder capitalism in October 2019. Benioff wrote an opinion piece in the New York Times that argued we need a new capitalism, saying that in the United States, income inequality has reached its highest level in at least 50 years. It's no wonder that support for capitalism has dropped, especially among young people. Will Ashworth continues, saying that over the past 15 years, Salesforce has delivered an annualized total return of 26.3%. 3. McDonald's. Former CEO Steve Estabrook was terminated last November by McDonald's. He was having a consensual relationship with a company employee. Let go without cause, Estabrook's severance package was worth almost $42 million. New evidence has come to light suggesting that not only did Estabrook have one inappropriate relationship, he had 3 others. Generally, I consider McDonald's to be an excellent company. I believe that these revelations will move McDonald's to more closely examine how it compensates its senior executives. 4. Blackrock. This isn't the first time that I've included Blackrock in a list of ESG-friendly stocks to own. In October 2019, BlackRock CEO Larry Fink made my list of 10 stocks whose CEOs care about all stakeholders. In July, Fink told CNBC, "The only thing that is very clear in this COVID world is that stakeholder capitalism is only going to become more and more important, and the companies that focus on all their stakeholders, their clients, their employees, the society where they work and operate, are going to be the companies that are going to be the winners for the future," Fink said. I couldn't agree more. It just makes good business sense. 5 is Xoetis. Xoetis appears to be a company that's working on improving its ESG characteristics. Xoetis scores particularly well from a government's viewpoint, and while the company does lag its peers slightly on environmental and social measures, it should be noted that the company's sole focus on veterinary medicines present a distinct risk profile compared to its human-focused pharmaceutical peers, Federated Hermes writes. As an animal lover, it's always nice to see animal-related businesses doing well by doing good. 6. Deere & Company. According to CSR Hub, John Deere, the world's largest manufacturer of agricultural equipment, has a CSR ESG rating of 83, putting it in the top quartile amongst 19,881 companies, and compared to 887 peers in machinery manufacturing, it has a much higher score than the industry average. In the past 3 months, John Deere stock has rebounded nicely, generating a 51% total return, significantly higher than its farm and heavy construction peers and more than double the returns of the US markets as a whole. 7. Progressive. Per its name, Progressive likes to think outside the box. Recently, it announced that it was entering the voluntary benefits market through its partnership with Pets Best, a provider of pet health insurance founded in 2005. What does this have to do with ESG? CEO Tricia Griffith is one of only 30 female chief executives in the S&P 500. With women accounting for just 6% of the index's CEOs, Progressive is undoubtedly paying attention to both governance and social issues. In 2018, Griffith was named Fortune's Business Person of the Year. In the 4 years Griffith has held the top job, Progressive stock is up 170%. End quotes. Zacks is known for its great research, and they've been increasingly covering the ESG investment space. Their latest piece is titled 4 Socially Responsible Funds to Invest in for Solid Returns. I found it on the Nasdaq.com site. As usual, I'll state the investment pick, followed by their relevant comments about it. 1. Pax Elevate Global Women's Leadership Fund Individual Investor Class. This fund aims for returns on investment that exceed the price and yield performance of the Impax Global Women's Leadership Index. The Pax Elevate Global Women's Leadership Fund Individual Investor Class has an annual expense ratio of 0.8%, which is below the category average of 1.1%. The fund has 3 and 5 year returns of 6.9% and 7.3%, respectively. 2. Fidelity Select Environment and Alternative Energy Portfolio. The fund primarily invests the majority of its assets in securities of companies that provide business services related to alternative and renewable energy, energy efficiency, pollution control, water infrastructure, waste and recycling technologies, or other environmental support, etc. The Fidelity Select Environment and Alternative Energy Portfolio has an annual expense ratio of 0.85%, which is below the category average of 1.1%. The fund has 3 and 5 year returns of nearly 2% and 6.4%, respectively. 3. The New Alternatives Fund Class A primarily invests in common stocks of companies. The New Alternative Fund Class A has an annual expense ratio of 1.08%, which is below the category average of 1.28%. The fund has 3 and 5 year returns of 10.4% and 8.8%, respectively. 4. The Parnassus Mid-Cap Growth Fund Investor aims for capital appreciation. The fund invests the majority of its assets in mid-sized growth companies. The Parnassus Mid-Cap Growth Fund Investor has an annual expense ratio of 0.84%, which is below the category average of 0.92%. The fund has 3 and 5 year returns of 7.9% and 8.7%, respectively. End quotes. Now, here's a thought. How about investing in oil companies that are transitioning to renewable energy? 3 analysts writing for the Motley Fool share their thoughts in a post titled 3 Oil Companies That Are Becoming Renewable Energy Stocks. Due to time limitations, I'll just mention the companies. Go to my blog post for the article link. The 3 companies are Total, Valero Energy, and Clean Energy Fuels. Well, these are my top news stories and tips for this podcast. ESG Stocks, ETFs for August, and more. And to get all the links, stock symbols, and more, or to read the transcript of this podcast and with additional information too, please go to investingforthesoul.com/podcast and scroll down to this episode. Also, be sure to click the like and subscribe buttons in iTunes, Apple Podcasts, or wherever you download or listen to this podcast. And please click the share buttons to share this podcast with your friends and family. That way you can help promote not only this podcast, but ethical and sustainable investing globally. We can all do our part in helping create a better world, especially in these very, very troubled times. Contact me if you have any questions. Stay well, healthy, and ESG wise. Thank you for listening. Talk to you again on September 11th. Bye for now. Learn how to create a simple portfolio reflecting your personal values by taking my 1-hour tutorial. Go to investingforthesoul.com/podcasts and click the link in the right-hand column for my DIY Ethical Sustainable Investing Pays tutorial. Now, I'll mention in the podcast if I have any direct interest or holdings in companies or securities I'm talking about. Furthermore, any news, opinions, analysis, or other information offered by myself, as well as references and information to or from other external sources in this podcast, is provided as general market information and should not be relied upon and thus does not constitute investment advice. Investors should consult their own licensed investment professional before making investments. Also, I will not accept liability for any loss or damage, including without limitation any loss of profit, which may arise directly or indirectly from use of or reliance on information in this podcast. Do contact me at ronr@investingforthesoul.com. Signing off, this is Ron Robbins.